So good afternoon, everyone, or morning, depending on where your time zone is. I'm Bella Alvarez. I'm a program associate at the Intentional Endowments Network, and we're really excited to have you all on today with Wespath Investments as we explore systemic risks and the future of investor engagement with their team. So before we begin, we're just going to do a brief intro about IEN. So the Intentional Endowments Network is a peer learning network advancing intentionally designed endowments through resource exchange, education and training, and forums, meetings, and webinars such as this one. We have 200 members. It's comprised of a mix of asset owners, asset managers, nonprofits, OCIO consultants. And in a little while, you'll see in the chat our commitment to JEDI, which is an integral and important part of our work. And we'd also like to direct your attention toward our 2023 Climate Leadership Summit, which will take place in Coral Gables, Florida at the University of Miami just a couple weeks from now, February 5th through 7th. So we hope that we can join many of you there. We'll be joining the Wespath Benefits and Investments team there, and we hope to see you. So before we begin, we'll just have a couple of quick housekeeping tips. So this webinar is being recorded. You will receive a copy of the recording as well as the resources shared and the slides after the event. We ask everyone to please use the chat function to comment, request technical help, and ask the panelists questions. We will have time for a Q&A at the end of the conversation. Our participants will remain muted for the duration of the webinar, so this will not be an interactive sort of learning cafe style. And we ask you all please to be present. That might mean taking out a pen and paper to take some notes or getting a beverage and just maintaining your emotional and mental presence. So I am going to pass it over to our speakers from the Wespath team. We're very excited to have them all on today. I'm not sure if Ryan is with us, but I think I can probably pass it over to get us kicked off.
Yeah, Bella, we're one short at the moment, and Ryan's joining. As we all know, in the Zoom environment, we're just bound to have COVID issues with Zoom, so he's rebooting at the moment. But for those of you on the call, I just want to make sure everybody can see our screen that we're sharing, which has biopics of Karen, Ryan, and I. I'm seeing head nods. Great. Okay. So I'll introduce Ryan. What I want to say about Ryan is he's the analyst and really works with our investments as far as the stewardship goes. He's got 7 years of investment experience, joining us in 2019. One of my favorite parts about working with Ryan, I would say, is he's a foodie. So he and I really get together and love to chat about what are good food joints in Chicago. But he really is perfect for the presentation today because he does a lot of engagement work and helps us create long-term investment value through the engagement framework that we're going to discuss. Secondly, I'll go and then I'm going to turn it over to Karen, but I've got about 16 years of experience, 2020 since joining Wespath. I work with, I would say, more of the analytical side of what we do here at Wespath. I've got a little bit of public fund experience, and then Karen and I did not work together at a bank in Chicago here years ago, but we crossed the same paths. So Karen, to you, and she's really Karen's the expert as far as Wespath goes. So this is great. I'm happy she joined.
Thanks so much, Evan. And it's such a privilege to be here today and also see some familiar faces here. So hello, I'm Karen Mansko, and my role at Wespath is really to support our institutional clients and helping them guide them through all of the important decisions that they need in their investment portfolios and also in incorporating sustainable investment guidelines into their investment program. So as everyone is continuing to join, Evan, if you just want to go to the next slide, and I'll talk a little bit about Wespath and who we are and what we do. We are one of 13 general agencies of the United Methodist Church. We were founded over 115 years ago to provide retirement benefits to United Methodist clergy. In 2010, due to really the success of the Wespath brand, we launched a separate subsidiary to manage assets on behalf of mission-focused investors and their assets not related to retirement, so their endowment assets and other assets that they would like for us to manage. Today, we are recognized as one of the largest faith-based investors of plan assets, and we have over $24 billion in assets under management. And one thing that we do is we use this scale to invest not only in world-class investment managers, but also to use our voice as a large shareholder to encourage companies to adopt sustainable business practices. We've received global recognition as being a leader in sustainable investing. And we do this not only because we believe it's going to create a better world for us all to live in, but because we believe it's going to create better long-term value for all of our investors, which is really important to Wespath as a fiduciary to all of the investors that we manage assets on behalf of. Some of the examples of work that we've done is we were ranked in the top 4% of the world's largest 500 asset owners in the Asset Owner Disclosure Project. We also were part of the first shareholder resolution to be passed by an oil and gas company, asking them to provide more detailed reporting in regards to the impact that climate change is having on their business. And this resolution that passed was the first of its kind. And this was in 2017. And some of you likely read about that resolution in the Wall Street Journal and other publications. And last, before I turn it over to Ryan, and hopefully Ryan's on now, is that Wespath was one of the first to launch an enhanced passive low carbon transition ready strategy. And this strategy continues to be part of our US equity and our non-US equity portfolio. And we launched this strategy in partnership with BlackRock, which is known as one of the largest asset managers in the world. So with that, hopefully Ryan's on. I'll actually, Evan, I'll turn it back over to you.
Yeah, Karen, I want you to cover one other thing, which is the investment exclusions. And that makes us a little unique. We've heard you describe for us time and time again our three-pronged approach, which is the invest, engage, avoid. Can you describe, just for the audience, a little bit more about our avoid approach?
Yeah, part of those three pillars that are of our investment framework that Evan highlighted is a portion of that is our investment exclusion. And this is the areas of the market in which we don't invest in based on the guidelines that are outlined in what we refer to as the book of discipline. So we look at companies that derive 10% of their gross revenue from alcoholic beverages, adult entertainment, gambling, weapons delivery systems, I believe alcoholic beverages, gambling, weapons delivery systems, private prisons, and so forth. So that's how we look at the exclusions in our portfolio. And I feel like there's one that putting me on the spot that I forgot to highlight.
No, you nailed it. You nailed it.
Got it.
And so that's the good segue into the next part, but that's the least amount of time. What Ryan's going to describe today really is about the engagement. Again, we have a team dedicated to this, but before we go into Ryan's background a little bit more, what I wanted to talk about is we've been spending a lot of time reflecting here at Wespath, documenting what we felt we were successful at as far as our 2022 goals. I was just curious from the audience if anyone would share or reflect on what was their greatest social impact in 2022. Any takers? I mean, I'll share mine. For what I had a firsthand account in West Virginia. A colleague of mine went to go visit one of our constituents down there, and we heard firsthand the work of his presence in the community of training people to use naloxone to help revive folks that had opioid overdoses. And so he was going around training congregants of the Methodist Church. It doesn't necessarily have to be Methodist, but really that resonated with the work that we were doing with our investors for opioid accountability. And so we've got another colleague of ours who's a co-chair of this committee, but they've done a lot of work to really put in clawback provisions on executive compensation. So to really see the work that Shirag and others on our team have done, and really I'm standing on the backs of all their work, but to also see the effects firsthand in the community and trying to really come back to Wespath and affect change in a positive way is really something that resonated in 2022. What else? Ryan?
Well, yeah, I might jump in and use that as an opportunity to share one of our team's successes, another one of Wespath's successes, and also introduce myself a little bit. So sorry for the delay. It sounded like Evan and Karen teed me up very well there, though.
I mentioned you're a foodie.
Okay, good. All right, cool. My reputation precedes me. That's great. So yeah, my name is Ryan McQueenie. I'm with our Sustainable Investment Stewardship team. So as Evan said, that is our dedicated engagement team. And we also handle all of our proxy voting work and some of the other kind of key sustainable investment activities that Karen had highlighted. I think it's really important that we share that history and the work that we do in the sustainable investment community, not to show off or gloat about our accomplishments, but to express to you all as an audience that the stuff we're sharing today is from that experience and from those kind of core perspectives. So we have the traditional classic old school ESG ethical exclusions background because of our connection to the United Methodist Church and those faith values. We have a ESG as a value adding approach perspective, and we incorporate that into our engagement and proxy voting. And so I think that's a really excellent tee up into engagement and stewardship on systemic risks, which is what we want to shift a little bit more into now. Before we do that, I just wanted to kind of talk about some key terms, quick little dictionary here so that we're all on the same page, because I know some of these conversations can be very acronym heavy, very alphabet soup at times. So just so we're all at the same page here, when we say stewardship, we're talking about what others might call active ownership or just engagement more broadly. So corporate engagement up from investors to corporations in which they invest, and then proxy voting. Those kind of core two pillars, and then some of the other uses of investor influence that we might call other forms of engagement that we'll get into a little bit later. To us, stewardship or active ownership is encompassing of all of those things. Also, if you saw the name of the webinar, obviously we want to talk to you about systemic risks today, recognizing that folks might be using systemic or even systematic different ways. To us, systemic risk is really just any type of investment risk that can't be diversified away. So again, for Wespath specifically, that probably means climate change and income inequality, things we've targeted or highlighted or activated work to try to address. But it's a really intentionally broad definition. And I think from this perspective, we also think it can mean anything to you all, right? Your institution, your investment committee, your board of trustees should feel empowered to define systemic risks how they feel is appropriate for your organization or your investment portfolio, and identifying specific systemic risks within whatever definition, I think is certainly another thing that the investment committee or the investment team should feel empowered to do. So while we might have a climate focus, I don't think we're intentionally trying to prescribe that to others. That definition of systemic is very related to the beta of the market, or what I've heard some folks refer to as beta stewardship, which is trying to connect both of those ideas, right? Obviously, we as investors know beta as a measure of total market risk. It is the risk of the market or the volatility of the market. When we talk about systemic risk, that's kind of the direction we're hinting at, right? That you can diversify certain risks away by how you choose companies, how you choose exposures to certain sectors and industries, how you choose exposure to certain asset classes. But that there are also, within those full asset class markets and within, the entire global economic system, issues that are large enough that they really cut across sectors, industries, even asset classes at times to present risks to really every investable product out there. And then finally, uncharacteristically specific for these slides, because those are all three very, very broad, intentionally broad definitions. We also wanted to just highlight the Net Zero Asset Owner Alliance. This is an initiative that we're a member of it's a global initiative of GFANS. If you all have heard of GFANS, it is a GFANS member organization. It's right now, I think we actually just crossed 80 this week. Asset owners from around the world, over $10 trillion in AUM. This is a climate focused organization. All members have made a commitment to achieve net zero portfolio emissions by 2050. The reason why I'm bringing them up now is that a lot of the work we're talking about today was from a paper that we co-authored called The Future of Investor Engagement, which we published through the Net Zero Asset Owner Alliance. So that paper itself has a pretty heavy net zero climate focus, but certainly has some principles that we pulled out and can apply more generally. But we wanted to just do a little hat tip to the Alliance and the work that came out of that, and that initiative specifically, which we'll cover a bit more as we go forward. Next slide, Evan. Thank you. Just recognizing also that I don't want to just throw out terms and then take for granted that everyone agrees with me on that, or that we're all on the same page as to whether these things are measurable and noticeable in the marketplace. I think a lot of really, first of all, I just threw in this image of the cover of Moving Beyond Modern Portfolio Theory, because I think if you want to learn more about what we're talking about in terms of systemic risk, this is a must read. It's also relatively short, so it's a fun, quick one if you're big into this stuff. One thing that this book raises throughout is some of that evidence for the potential impact of systemic risks, or as it says, more systematic risks, total market risk. There's obviously a ton of perspectives shared throughout this book, and there's a ton of perspectives we could pull out. No easy way to go, here's your evidence and call it good, right? I think it's kind of an ongoing field of study here. But I think one big takeaway would be, or two pieces of evidence I would point everyone to in terms of why do I need to care about this, is how important the mechanisms of the whole market are to our returns as investors, right? I think, we'd all like to be excellent stock pickers. We'd like to be able to say we have a 100% track record of hiring asset managers that are amazing stock pickers that always outperform the market. We'd like to be able to say our external consultants just always nail this stuff, but we also know that's not necessarily the case, right? It's very hard to be an amazing stock picker year over year, nearly impossible. And that's essentially what these two pieces of research point us to. The first being kind of a foundational piece of research, which makes the argument that, the big thing for long-term investors is really asset allocation. And your asset allocation decisions are going to, explain the vast majority of the returns you have over the long term. And then later, Ibbotson gets into another side of that coin where he argues, hey, actually, it's not asset allocation. It really just within a given window is overall market movement within whatever snapshot of time you're picking out. And so, yes, long-term investors need to be more concerned with asset allocation, pensions, endowments. Asset allocation is a key thing for them. For your traders, it's really just going to be about the momentum of the market at the time that they're active in. Pick whichever piece of research you want, or whichever one you feel more passionate about or subscribe to. Either way, what we can conclude relatively fairly is long-term investors are much more affected by systematic market forces, whole market forces, and beta than idiosyncratic risks at individual companies or performance at individual companies that they're over or underweighted to. Again, it kind of gets back to that, I'd love if I was an amazing genius stock picker 100 times out of 100, but I'm not. So that's not our investment approach, right? We're a near universal owner. And so we're much more exposed to whole market risk than, other forms of investors would be.
Hey, Ryan, one of the things that I think was somewhat born or spun off of this is that as a fiduciary, if you exclude out some of these stocks and you make allocation decisions that exclude out alcohol, tobacco, firearms, sort of the things that Wespath does, you're really going to miss out on your upside, and you're really jeopardizing your fiduciary risk or putting it into question. And what's interesting is at Wespath here, we've tracked those exclusions 10 plus years, and it's really negligible. And Karen sleeps in this space and knows it very well, but it really doesn't indicate or show that we're losing out on performance. If anything, it showed that we've had positive performance ever so slightly, and not enough to compromise as us a fiduciary our risk in that space. But Karen, I'll turn it.
No, I think too, with our exclusions that we have, we're only excluding roughly 3 to 4% of the market. Some people, when they think of investment exclusions, they think that you are removing a big chunk of the marketplace, but really, given the exclusions that I highlighted earlier, it's only 3 to 4% of the market. So it's not a big portion of investment portfolios that these exclusions are having an impact on. And yeah, like you said, we believe over the long term that our exclusions neither help nor hurt the long-term performance of our funds.
Yeah, it's a good note for folks who may have mandates that require them to have ethical exclusions or sectoral exclusions as well, that within a given time frame, a shorter time frame, you may see noticeable effects there. But over the long term, our experience tells us, for the small chunk of the market that we exclude, that it's really not super noticeable. And then the research says, over the long term, that ends up showing itself to be true as well. So yeah, good points, Evan and Karen. Thank you.
Karen, I'm going to turn it over to you. We're going to let Karen talk about why this is relevant for endowment investors for a moment.
Yeah, endowments, like other asset owners, have long-term time horizons. For the most part, endowments exist in perpetuity. Therefore, they're often faced with most of the systemic risks that are associated with climate change and other areas of the market. According to an Akubo study that I read when it was published, the most recent report is that endowments have increased their responsible investment practices. And this has primarily been due to the increased pressure that they're under from their stakeholders to confront climate change through their investment assets, or what they can control through this. Where endowments struggle the most, and I think everyone on here can agree, is how to address these risks, and particularly how and where to address these.
Evan, we lost the slide, by the way. Yeah, there you go. Cool.
I think where endowments struggle, again, as I noted, is that how to address these risks, particularly how and where to implement them in your investment portfolio. This is where investors often look to Wespath. They look to us in providing them guidance and how they can do and what work that they can do within their investment portfolio and outside their investment portfolio in addressing climate change and other risks that are associated with this. And I know, Ryan, that you had some really great examples that you wanted to review with everybody.
Yeah, I think just the important thing there is just trying to connect the logic into what we want to talk about with engaging on systemic risk, right? If we can all agree as long-term investors, as near universal owners, as long-term focused asset owners, we are really exposed to systemic risks. Those are the types of risks that are likely to have the most impact on our portfolio over the time periods which we care about, which are very long-term. Then we have a vested interest in trying to reduce or manage or mitigate those risks, right? It makes sense from a fiduciary perspective for us to seek solutions that mitigate those risks. And, I think a lot of the solutions and a lot of the work that we can do there comes through engagement, which we'll kind of touch on specific as examples and engagement strategies, as Karen said. Before we get into that, though, I just wanted to do a couple quick housekeeping notes on where this has come from. Like I said, Net Zero Asset Owner Alliance paper, Future Investor Engagement. I saw someone throw it in the chat already. Thank you to the IEN folks for doing that. That is where a lot of the specifics of what we're mentioning today come from. And like I said, it does have a climate focus, though we think the principles can be applied more universally than that. Those examples and experiences shared there and kind of the perspective that guided that paper mostly come from experience with engagement through the public equity markets, right? Engaging with companies as a shareholder. We think that this can be applied to, fixed income investors and debt holders. I've been involved in many engagement conversations where folks are not shareholders, but are debt owners and still come to those conversations, and companies still want them to be in those conversations. We certainly do engage with our private equity and our alternatives managers on ESG risks and opportunities. So I think there is room there to be doing more. But we just want to say most of the perspective here is coming from an experience in that public equity asset class stewardship, kind of traditional stewardship function. The other thing I think is important to note is that we are obviously coming from this with the developed market perspective, right? We're based in the US. We are primarily engaging US-based companies, though we do have engagements and have had some historical engagement examples of non-US companies or engaging on things that are not occurring in the US. But we recognize as a US or Western organization, we're going to have a particular point of view. And I think investors with experience in or based in emerging markets and developed economies would certainly benefit this investment stewardship ecosystem. And we certainly hope that we continue to grow there. We're talking about more breadth and more depth, the engagement community. That's really what we'd like to see and what I think would really benefit this work. So we get into that in the paper as well. I just wanted to shout it out today before we fully jump into the solutions. And then we also wanted to just note, those engagement experiences, like I said, mostly coming corporate engagement with publicly listed companies. Feel free to disagree with me or correct me if I'm wrong, but we feel this is pretty much the vast majority of the engagement ecosystem right now. We think it's had some really amazing accomplishments. Karen noted a couple that we've been involved in through the years, some shareholder resolutions we've worked on to help get them passed, some dialogues that have resulted in positive progress. Most of this is collaborative as well. Certainly we do have bilateral conversations, and we know of larger investors that have bilateral conversations. But I think most of the really exciting momentum is coming through collaborations. On the climate side, Climate Action 100+ is obviously a great example of that. We may have some folks on the call today that are also members or signatories to CA 100+. But groups like that, Net Zero Asset Owner Alliance, another example, groups like that where folks come together and kind of pool up their influence seem to be where a lot of the energy is devoted today. And that's certainly a good thing, though we'll get into some ways to improve and expand and build on that momentum.
Thanks, Ryan. So just onto another question really quick. I was just curious from the audience, or Ryan, Karen, if you want to share just how what we described really squares with your understanding of engagement. Or said a different way, does anyone have any engagements recently that they've worked on that they'd like to share the outcome or process of it?
Yep. If I could add another question, that does anyone in the audience, feel comfortable sharing if they use an external manager or an investment consultant, whether what I just described is stuff their manager or consultant is talking to them about or reporting back on? I'd be really interested to hear and your reflections on what managers and consultants are sharing with asset owners right now.
All right, Ryan, I'm gonna turn it back. I'm not hearing anything on the chat line
That's cool
at the moment, but I'd love for you. So the next phase of our presentation is really, you're going to go into the thesis of the white paper. So we'd love to hear from you, just the work. And here we go, the limits of corporate engagement, but
Yeah,
also the thesis there.
yeah, for sure. So just want to keep that invitation to converse open at any point. We'll have another handful of question breaks here built in, but feel free to jump in again with any of those experiences from your own engagement work or what you're hearing from managers or consultants. Be really interested in how that aligns with what we're talking about. But yeah, so what the paper does, the paper that I've been referencing, what we want to outline today is where the awesome momentum of corporate engagement and the engagement landscape as it exists today kind of hits a wall or runs out of steam or effectiveness in regard to managing those systemic risks as we defined earlier in the conversation. So the paper outlines 5, not because we think there's only 5, but because we thought 5 was a good way to get the message across, and because we had 5 we really had some conviction behind. I don't want to go through all of them one by one, but some highlights from the first 4 that I would say are, this is really resource intensive, right? Going back to what I mentioned about being a universal owner, having exposure to, total market risk and thousands of companies around the world that we're shareholders in. We obviously don't have the capacity to engage all of those companies, even if we just wanted to pick one systemic risk like climate change and only engage all companies that are emitting, that'd still be thousands and thousands of companies that we can't cover with the capacity we have in-house. Now we can make up for that a bit because our asset managers also engage and have stewardship teams, but even then this is really resource intensive. And to really have a strong understanding of every single company, their low carbon transition plans, their emission reduction plans, and then have the time and access to actually have those dialogues. It's really challenging. I think the other thing is, despite all of the positive successes of something like Climate Action 100 over the years, a lot of engagement, especially on climate, is still really focused in on disclosure, which I don't want to discredit. I think disclosure is extremely important, but disclosure is not itself emissions reduction in the case of identifying climate as a systemic risk. And so we put all of this time and energy into a voluntary disclosure framework and trying to have a company align with that, and we still have kind of a ton of work, obviously not kind of, definitely a ton of work to do in regards to actual action on reducing emissions and addressing the systemic risks of climate. So I think that can be a bit frustrating and a bit limiting at times for the space. And then, as I mentioned earlier, right, I think it's tough to have a clean, even focus across companies and asset classes, right? We are inherently and kind of fundamentally coming at it from the public equity stewardship perspective. Private companies are a huge factor here. I mean, for oil and gas specifically, right? It's over 60% of the global market, might even be more than that, is owned by a state-owned enterprise or a nationalized energy company. And so we put all this focus into a handful of companies that themselves don't even have the largest impact on the systemic risk we've identified. We could also talk about the offloading of those idiosyncratic risks, right? So if I'm engaging an energy company, I want them to reduce their emissions. They may take the dirtiest chunk of their portfolio right now, their property portfolio, their operational portfolio, sell it to a private company or private equity firm that does not clearly care about transitioning assets, and now it's in the hands of a dirtier owner, so to speak, that isn't from the same, maybe coming from a different geographical area, that they don't feel the same investor pressure, and so that is also a risk. Ultimately, I think all of these kind of wrap up into limit 5, which is really the boundaries for how far corporate engagement go. And our main thesis here is that the rules of the game, or the policy and regulatory frameworks in which we as investors, in which all companies operate, are ultimately what's going to set how far we can progress with things like corporate engagement, right? A company may welcome engagement with investors, may agree with some of the things investors are saying to them or encouraging them to do. It may take that encouragement and make progress on this, on something like climate change. But it is not going to put itself in a position voluntarily where the products it serves or the things it produces are economically unviable, right? It owes, responsibilities to other stakeholders that kind of disincentivize it from pursuing things that are not viable. And what we see time and time again in things like the climate conversation is that the economic incentivizations that need to exist to really inspire, massive emissions reduction at the scale that the science is telling us goes beyond economic viability right now. And so we need to start thinking about how to have an impact on those policy regulatory frameworks, which is really what we get into next on this next portion of the slides.
So Ryan, I'm going to flip forward to the sector and value chain engagement, but you're also going to talk about policy engagement. There's a third pillar I wanted to ask you, which is identifying current opportunities in your existing stewardship policies. And sorry to put you on the spot here, but I was just kind of curious, since your evolution here at Wespath, what are some of the opportunities that we've seen within our own proxy voting policies or what's your take?
Yeah, I'll say this. We talk to a lot of investors or have heard from like-minded investors that are themselves not super comfortable getting into policy engagement. If we can agree systemic risks affect us as long-term investors, which I think we all probably can, and if we can agree corporate engagement is great, we should be doing it, but it doesn't go far enough to address those systemic risks. And we can agree addressing those systemic risks is, aligned with our fiduciary duty, right? We should be seeking solutions to those systemic risks. Then kind of the next step that seems implied by all three of those things is that we should be going, above and beyond with our engagement work, trying to find those systemic solutions. I think as we'll talk about, policy engagement is one of those things, but unfortunately for some folks, you don't have the capacity to do that. You don't have the resources to do that. You don't feel like you have the right experience to do that, or you think to external stakeholders, maybe to your board of trustees, to your constituents, to your alumni base. That might sound like you're lobbying, right? Policy engagement kind of rhymes with lobbying. Some folks are not allowed to do that legally, or don't want to, have folks interpret that their work as partisan lobbying or political influence, which I think is a fair consideration. Certainly something we have had to grapple with ourselves, and
which is what you're saying. We're bound by the rules of the game within.
Right.
Lobbying is one thing that you're really referring to within the white paper. Right.
Again, if we can agree, hey, we are bound by these rules of the game, or the policy frameworks, the regulatory frameworks, the existing law that creates economic incentives, then to change those frameworks, we are going to have to engage with policymakers and with regulators. If you're not comfortable doing that, if you're not in a spot where you feel like you have the experience or expertise to do that directly, one good starting point would be to use your experience with corporate engagement, use those classic corporate engagement frameworks, proxy voting, things like that, to start talking to companies, dialoguing with companies, encouraging companies to move forward on their own lobbying, right? So we know the corporate community holds a lot of influence, not just in the US, but around the world. Company political advocacy is very influential in terms of developing policy and regulatory changes. Unfortunately, right now, a lot of companies that have made big commitments, again, sticking with the climate theme, a lot of companies that have made huge climate commitments are also on the other side of the house lobbying against climate policy that would help them achieve those commitments. And so you can stick within the realm of corporate engagement, direct corporate engagement, those things you might have more experience or capacity for, but be talking about policy engagement within that by saying, hey, we want a lobbying report that talks about the alignment between your climate commitments and the spending that you have contributed in terms of, you know, lobbying activity or memberships in trade organizations, things like that. So to go back to your original question, Evan, that would be my main point, is just start somewhere. If this is resonating with you, but you don't know exactly where to start, or jumping straight into policy advocacy is intimidating, start somewhere. And I think you can start with those traditional corporate engagement proxy voting steps.
Yeah, I always like here at Wespath how we ask the team to vote proxies too. So even if you're not in Ryan's group, Karen and I and Joe and others on our team are going through and we're voting proxies, and we vote it in accordance with our guidelines. And it really, I think, empowers us. You know, then in Joe's case, it led to him with an engagement with Meta, you know, talking a little bit about some of the work there. So
Yeah,
I think it's like a snowball effect, right? You start to do it, you put some time into it, you get to understand what's going on, voting proxies, whatever it is, reaching out to an investor relations department. And then you start to affect change as that snowball gets bigger and bigger.
yep, yeah,
So-
exactly. I think, you know, that's a great another kind of tip off of start somewhere. Is if anybody's, you know, anyone in the audience right now is wanting to build more knowledge or expertise or momentum within their own organization on these things, and you're going through proxy voting, or you're going through your external managers proxy voting policies, just getting everyone involved in that process so folks know what a company's proxy statement looks like, and what are the types of things an oil and gas company is publishing in their annual reports and their proxy statements in 2022. In 2023, it might surprise you. And I think it certainly will help build that knowledge internally. It certainly has for us here at Wespath.
Thanks, Ryan.
Yeah. And on this note, yeah, so we start getting into solutions a bit more here. So, you know, we talked about systemic risks, right? We know those are affecting us as long-term investors. We know we've had experience using our area of an influence as a long-term investor to enact change. We know that process of corporate engagement is maybe not going to be the most efficient or effective in terms of addressing those systemic risks. What can we do? Sector and value chain engagement, not something with a universally agreed upon definition, but what I mean here is instead of having a company specific discussion, instead of having a group of investors talk to one company, one CEO, one chief sustainability officer, trying to convene more roundtable discussions, panel discussions, engagement conversations that include stakeholders from around an entire sector or within an entire value chain, right? So if I'm talking to, you know, an equipment manufacturing company, I'm also talking to their customers, and I'm also talking to their suppliers, and I'm trying to find time to gather all of those voices together at once so that solution identification can happen within the same room, within the same dialogue, and that investors can be real time offering feedback to all the folks in that value chain on those solutions. I mean, if you go to the next slide, we do have an example of this. An investor mining and tailing safety initiative, one of the best examples out there. It's not a climate specific one. It may not even be something that is directly pointed at a systemic risk as we have defined it, but is certainly one that shows the power of sector and value chain engagement. You know, following a series of safety incidents, dam failures at these big mining facilities that really devastated local communities and caused loss of life. An investor group formed to develop new safety best practices for the mining industry, ended up getting over 700 companies that were involved in the extractive industry involved. And within that network, investors and companies from the whole sector working together, they developed a new, completely proprietary set of globally recognized safety standards for folks in the mining industry. And I guess, again, I think it really has to do with investors were there, folks throughout the value chain were there, real-time feedback with all those stakeholders. were able to come together and develop a new widely recognized safety standard. I also think it gets you out of some issues we've had where if I'm talking to an equipment manufacturer about the need to develop, more electric vehicle options for their mining equipment, and they're telling me, hey, our customers don't want it yet. We're not seeing the demand that we need for it. And then we're also having engagements with, mining companies and those customers, and they're saying, well, there's just not a lot of economically viable product out there for us to transition our fleet of equipment with. I see a disconnect in that conversation between supplier and customer. And if we can spend more time in conversation with both of those folks at once, we can directly address those disconnects rather than trying to connect those dots for ourselves.
Yeah, I remember that mining incident or dam incident left 270 people dead. That was 2019, just catastrophic. So the fact that there was not a global database of all these various tailings facilities that were stored below ground, I mean, what a great thing to know when you're going into an area.
Yeah.
Heaven forbid doing more mining in that area.
Yeah.
And gonna shift
good
the ecosystem there.
Yeah, it's a great point, right? I think, it's not necessarily a systemic issue as we have defined it earlier, but certainly within the mining sector, safety is a systemic topic. It's one that the whole value chain is exposed to. And so I think it is a good example of a solution there. I kind of stole a bit for myself earlier when I talked about ways to get started on policy engagement, which is essentially engage companies on their own policy advocacy. That's what's listed here on approach 1. This is really focused on making sure companies are disclosing their lobbying activity. There are, of course, a lot of current legal mandates and regulatory policy for what companies do have to share in terms of where their money goes and the types of things they're paying for folks for. But we also know that there's a lot of corporate influence that lives below the surface there, and that those disclosure documents are not super informative at times about what specific policies are being supported. So pushing companies to disclose more, encouraging folks to regulators to require better disclosure on lobbying is a really helpful point, and it kind of gets to very similar theme that I mentioned, engaging portfolio companies directly on industry associations, right? So we've talked about better disclosure on lobbying practices, engaging on the lobbying practices. Better disclosure and engagement on industry associations is really key here. And again, it takes the form of regular corporate engagement, just with a specific policy focus, right? So company might say, well, we don't spend any money on lobbying directly, but they are a member of 3 or 4 industry organizations that do themselves a lot of direct lobbying that doesn't disclose exactly what it's lobbying for and against, and that is supporting laws and policies that are not aligned with the commitments that have been made publicly by its members. This is certainly something that happens a lot. It's something companies are aware of, something investors are asking companies for action and disclosure on right now. So, if you're at all involved in engagement on things that need policy solutions, really start asking those companies you're engaging with about their industry associations and their lobbying activity. I think you'd be really surprised to hear how this tends to play out and some of the progress that we can make by investors asking these questions a little bit more. The third approach is that one that sounds a lot more like direct lobbying than some folks might be comfortable with, which I think is fair enough. But I think we do need to embrace using our investor influence to affect change in the policy arena, right? We are certainly able to and at times invited to offer our voice as investors. on policy and regulatory matters. I think these can have a huge influence, and I think folks should be spending more of their engagement resources on policy engagement, because it is, as we mentioned, those boundaries set by the rules of the game, the boundaries set by the policy and regulatory environments. It's a reality of the types of issues that we're talking about here, whether it's climate or another systemic risk. The kind of core solutions that are needed are policy changes. Some examples of this, again, areas where we're allowed to or encouraged to, and areas where we're expressly invited to do policy engagement. The SEC specifically wants to hear from investors of all sorts, and certainly wants to hear from asset owners like ourselves and the folks tuning into this call. So we participated last year in the feedback process on the SEC's climate disclosure rule, which was hotly contested, and another one where industry associations and lobbying groups were heavily involved in that feedback process. You might say, hey, what does the SEC care about my one voice as an investor? I'm sure other investors are chiming in. I agree with them. The SEC does care. It is actually valuable to their process, the more and more unique voices of support that they get. If you missed your chance to get involved in the climate disclosure rule, we are expecting to see the SEC offer a new human capital management disclosure rule this year. This is another systemic risk that I think all folks probably on this call can identify or agree with to some extent. And right now there is very little mandated disclosure in the US on human capital management practices. And so offering your voice as an investor there would be a really good first step in getting involved in policy engagement. Obviously, the SEC is the one we face most as investors. So I wanted to make the point that it's not the only body that you should be engaging with or you can engage with using that investor voice. Last year, we also chimed in on some proposed methane regulations by the Environmental Protection Agency. And so I think this is a good example of other areas and other regulatory bodies where we can have an influence. They're underlined because they're hyperlinks in direct comments. So we should be able to set the slides out later and you can read exactly what those letters say. And we disclose all of the position statements and public policy letters that we send out on our website, which is a good transparency best practice I would encourage everyone to adopt as well.
Hey, Ryan. So this is a good segue into the Q&A. We got one in the chat and I'm going to read this to you in real time. And so Mark is asking, can you discuss resources or ongoing efforts to coordinate investor engagement in action? For example, coordinating divestiture of fossil fuel companies to explicitly active investors dedicated to supporting climate action. So Mark, and I just want to make sure hearing that second part, coordinating divestiture, and really I think what he's referring to is monitoring the divestiture of fossil fuel companies. That's kind of how I internalize it. What are your thoughts, Ryan?
Yeah, I might might ask for a bit of clarification on the question just so I don't answer with something you're not interested in. Because I read that second part actually as being about NGO forces or climate advocacy. Got it. Okay, so it was Evan. Evan, you read that correctly. Okay, so yes, to avoid selling to investors that don't care about climate change. Yeah, is there momentum behind resources or folks in the engagement community monitoring that specific point? I don't know of,
so, yeah, I'm gonna try to maybe articulate where I come from, and Mark, feel free to hop in. So your point about clarification to avoid selling to investors that don't care about climate change, a large part of whom I'm engaging with are people in the South and Southeast. And as you can imagine, when we're talking about Wespath in climate change, oftentimes that message doesn't really resonate. But how do you avoid selling to investors that don't care about climate change, for example? Well, really encouraging them. So obviously you're not.
Yeah, Evan, sorry to cut you off
Yep,
there, but
yep.
I do think what we're talking about specifically here is making sure that companies, oil and gas companies themselves are not offloading their assets to investors that don't care about climate change and aren't putting that pressure on them through engagements. Mark, is that where you were focused at? Do we have a resource for tracking divestiture to make sure, to monitor whether oil and gas companies are, sending their dirtier assets to more problematic investors or companies?
Sure, and I'm sorry to break the rule about being muted, but just I think it's more efficient than trying to do it in the chat. And I appreciate you answering my question. So really just thinking about the different approaches to being to divestiture and creating a portfolio that supports climate action. And one of the approaches is divestiture from fossil fuels, but the issue with that is what you're really doing if you're just selling into the market is that you're selling to managers and broadly the parts of the market that in general are not considering climate issues or are not necessarily prioritizing that because they're fine to own those assets. And rather than just selling it, then you have the other side where you have active investors, and you can see, for example, one of the great examples is engine number one, what they did with Exxon. Is there a mechanism that is, well, legal and can be coordinated through the public markets so that when there's a coordinated action to sell on the one side from those managers or endowments or whoever they are that don't want to really be involved in that process of engagement and coming in, that's not their, they don't have the capability to do that, but then sell to those who are, that would be able to come in and drive that change through positioning directors on boards and influencing energy company strategy. And that's sort of one large thematic example, obviously, but do you know of those sorts of mechanisms that exist? Because it seems that'd be a lot more efficient than just selling it out and then into the market, and then hopefully somebody else will buy a bunch. That gets to sort of
Mark, I just want to restate what I think I heard, which is that you're talking about both sides of the coin, and the one side really being is, if you're selling as an investor, an activist type investor, these oil and gas companies where you're not going to engage, you want to make sure that they're going to a good part of the market that is not necessarily used to just be an offload, for lack of a better word. Okay.
That's
right.
And actually then losing influence because now the only owners are the ones who don't care about climate change.
Right.
Ryan, maybe you can talk about our investment approach. I mean, I think of our transition ready strategy, where we over and underweight sectors of the market. And then also, I know we do a lot of portfolio optimization with BlackRock, who manages quite a bit of our index. So maybe, Ryan, you can talk a little bit about that. I think that would cover what Mark's looking for.
Yeah, for sure. So I think, first of all, Mark, what you've described is from our perspective and a lot of our peers' perspective that do a lot of this, engagement and more activist work on the climate topic specifically, is one of our core rationales for staying invested and not implementing a mandate where we are going to divest from the entire fossil fuel sector or the entire energy sector or what have you. It's one of our core rationales of we want to stay invested so we still have that influence, so we can still engage, so we can still vote proxy, so we can still try to move companies forward. And of course, you're also describing a huge risk for companies or for investors that do engage, right? If we engage companies so hard on climate, they might want to just sell offload their dirty or highly emitting assets. And of course, with every divestment, whether it's an investor doing it or a company divesting part of their operational portfolio, there's a buyer on the other side, right? And if I'm selling because I am worried about climate risk, I might assume that the buyer on the other side doesn't care as much about the climate risk that they're buying as I do. And the systemic risk of climate change because of that transaction has not changed at all. You know, the emissions are not getting reduced at the company because of that transaction. And in fact, they might have gotten more risky because now they're owned by an investor or a corporation that doesn't really care as much and isn't going to move as fast or as forward on this issue. So in terms of solutions and things I've heard about or things that are out there, there is definitely not one clean marketplace for connecting folks that are being forced to divest or choosing to divest. You know, some folks, some investment committees, these are things coming to them from external stakeholders that are getting passed into their policy statements without you know, direct, you know, they don't have direct control over. I know I can think of a peer in one of our initiatives that was a group of universities in a particular region, and it was a public university system, and the government passed a law asking them to divest from fossil fuels. It wasn't something our investment committee had come up with. And so in terms of an area or a marketplace, maybe where folks that are in that position can connect with investors that are, you know, engagement oriented and will carry on their work. I don't think that really exists. And I think, you know, you'd have some logistical issues in terms of, you know, for publicly traded companies, even, you know, activating a marketplace like that. Private equity, folks with direct infrastructure investments in oil and gas, folks with direct or co-investments in energy companies, that might be a little bit more possible, though I don't know of one, you know, a marketplace where that exists now. One example I do think you might be interested, though, based off of that question is the Climate Action 100 Net Zero Company benchmark methodology, which not on the investor to investor divestment sales, but on the company divestment and kind of capital allocation strategy does incorporate this into their benchmark assessments. And so this is CA 100 plus analyzing company transition plans. I think it's 0.6 here on the link that I just sent is capital allocation alignment. Part of what they are asking or seeking companies to do is publish a low carbon transition plan and then also tell us how your capital expenditure and portfolio allocation decisions are going to get you to that climate transition plan because of this exact risk, right? They don't want companies offloading a bunch of their highly emitting assets to you know, investors or, you know, other corporations that don't care as much about that climate risk. They want to hear that companies are thinking about those decisions that they're going to have to make well ahead of time and in alignment with the commitments that they're making. So I do see there some momentum from the investor side, making sure companies are aligning with that. So some progress on that theme, but certainly a huge risk and a lot of work to do.
Yeah, Mark.
Thank you both for that. Yeah, really appreciate it.
Thank you for the question.
Yeah. If I could, I got a quick, I don't think it went to the whole group, but someone just sent me a quick question as a follow-up to something we were talking about earlier about how do we ensure that when we're engaging with companies, the individual is knowledgeable about the company and is perceived as credible, and you know, making sure that we have folks that are trustworthy or credible or experts in those conversations, right? So such a good point and such a challenge because we are not equity research analysts at, you know, sell side investment banking firms that know a handful of specific industry companies like the back of our hand and are in those earnings calls and are chatting with the C-suite and really deeply and intimately familiar with all of their business strategies and nuances and, you know, competitive advantages and things like that, right? We as engagers kind of fundamentally have to be a jack of all trades. Now, of course, folks with bigger engagement teams, the BlackRocks of the world, do set up their engagement folks, their stewardship folks, to have direct expertise. But you've identified a real huge challenge where if we want to engage on climate generally, that's going to take us across a lot of sectors, a lot of industries, a lot of companies, and we just don't have the expertise or the resources to be knowledgeable about every single one of them. And I think it is a tough relationship, risk when you're sitting in a meeting with the CEO and the CFO of a company, and you're trying to talk about specific, CapEx decisions that those companies have, probably thought long and hard about, and brought to their board and had long discussions about. And we as investors or as consumers of their annual reports, proxy statements, sustainability reports, are only seeing a window of that. So we do our best. We identify, a handful of thematic issues and sectoral, sectorally strategic companies to focus on. That's how our approach at Wespath. I think every investor is going to do it a little differently. But
Ryan, I think it's too good to note how we partner with a lot of external coalitions and investor groups. Again, one, not only increasing our voice, but also leveraging a lot of the expertise that they may have when we are engaging on these particular sectors of the market.
Yeah, that's a really good point. That's a really good point. When we do a Climate Action 100+ engagement, we're going to have a resource there from the Secretariat of the CA100+ that is dedicated to the companies that they are focused on engaging, that does have a lot more of that industry specific knowledge. And then we're working with, in those engagement conversations, it's around a dozen other investors. And you're going to get all that experience baked in. It's another good reason why the engagement landscape today is so collaborative. You're pooling your investor voice, but you're also pooling all your different perspectives and experiences into one conversation, which is super, super valuable.
Okay, thank you, Ryan and Karen. I know we're at time. I just want to check before we close out. Any other questions or issues, Bella, that we can address? Okay.
Yeah, I want to also shout out while we're on this, the questions we kind of jumped through. We want to get these slides out to y'all for sure. There were links in there that I'm happy for you guys to explore. And then these last couple of slides we haven't dived into, or anything that we skipped over, more examples and resources and tips and tricks that we wanted to offer to you guys. So feel free to make use of them.
Yeah, thank you for having us. We're looking forward to seeing everybody in Miami. Happy to chat in person if there are follow-ups too, if not virtually.
Thanks so much, Evan, Karen, and Ryan. We really appreciate you joining the IEN membership and sharing all this information today. And we just wanted to let everyone know, just like Evan just mentioned, that we will be in Miami for the Higher Education Climate Leadership Summit in a couple weeks. So we hope many of you can join us there. And we thank you all for joining.